But let's start our conversation for the day on Talking Point. Aditya Khemka, fund manager and InCred asset management, joining us on the show. Aditya, great to speak with you. And especially at a time when so much uncertainty and everything sort of up in the air. How long, let me start with a moot point. How long do you think it will take to settle before we're clear what the new president of the United States is going to do?
So first of all, good morning and thanks for having me. On the uncertainty in the macro environment, I think the United States president obviously signed a number of executive orders as soon as he took charge. But these executive orders may or may not have implications on various sectors and various industries that we look at. The whole point is that when these orders are signed, obviously the market tends to panic and go back to the previous term of the same president. We saw a lot of noise around H-1B visa, immigration, so on and so forth. But if you look at what happened because of those measures to corporate earnings, to stocks in India over a longer period, I don't think it was a material impact at all. So I think it's more about the rhetoric, more about the narrative rather than the actual impact on earnings and value of the companies in our listed universe. So we tend to ignore such noises. In fact, we use panic situations like this to buy stocks at great valuations. And that is what I think we are looking at this point in time.
Shopping right now at this point, Aditya, and what would you define as great valuations? Because the one complaint we hear constantly in this market is valuations.
Absolutely. So what we look at in terms of valuations being great is we look at if valuations for a given stock or a company is below the 10-year average that the company has traded at. And it need not necessarily be priced to EPS or EV to EBITDA. It could be enterprise value to operating cash flow. It could be enterprise value to book value of the company. So, sometimes when your earnings or EBITDA are unstable, either artificially inflated or deflated, your PE or EV/EBITDA tends to give you a very irrational output and not the correct number. But EV to book value or EV to operating cash flow are probably much more stable numbers, which gives us a general sense of how stocks are being valued. So anything below 10-year historical average valuations tend to be lucrative for us.
Aditya, are you penciling in a decline in growth in terms of your expectations from what you would have potentially or possibly expected about 6 months ago when it comes to your outlook in FY26?
Yes, we clearly have seen some downgrades in terms of earning growth expectations, especially for the large cap universe. I think one narrative which was built maybe a couple of years ago is larger companies will keep getting larger, they'll keep getting market share, and they'll be the larger generators of profits and cash flows in our market. I think that theory has completely got debunked, and we were expecting a broader based growth in the market in terms of smaller companies also experiencing significant profit growth. If you look at our fund positioning, we are largely small cap oriented fund, very less exposure in mid cap and large cap, close to nothing. So we are clearly more focused on smaller companies that have the ability to gain market share, grow profits faster than their larger peers. And I think that's a trend that will continue. So to respond to your question, yes, larger company growth expectations, what we had a year ago compared to what we have today, there is clearly a decline.
Let's talk about pharma, because I know you track that closely and focus on it, Aditya. And while we spoke broadly about tariffs in the US and impact, how would you see that in the context of pharma companies?
So historically, Tamanna, if you look at these tariffs, etc., pharma is one space that tends to be relatively immune to it. Because it's a very globally integrated supply chain when it comes to pharmaceuticals. And in that space, if you apply tariffs and all, you are inviting inflation. The very reason why US imports generics from India is because our cost of manufacturing of generics tends to be significantly lower, 30-40% lower compared to what US is able to manufacture these drugs at onshore. So if you were to apply tariffs, then you are inviting inflation in healthcare costs within the United States by 30 to 40%. And that's not something that any administration would want. So logically speaking, it doesn't make any sense to me that there would be tariffs applied to the pharma space specifically in the US.
In terms of the overall tariff impact, would there be any impacted sectors from the Indian perspective? What would you look at in terms of defense companies, solar equipment manufacturers, etc.?
Yeah. So as you said, I think mostly
or even IT actually.
Yeah. IT again, IT I think is kind of relatively safer given the arbitrage in manpower cost that we have of offshore labor versus onshore labor. So again, unless the United States is prepared to digest significant inflation in IT infrastructure cost, they would have to continue to import, IT labor. And I think that's something that the economy will continue to do. I don't think there might be some restrictions on H-1B visas, and again, some restrictions on how much onshore, how much offshore, etc. But those would be marginal tweaks and may not change the overall picture for IT companies. But industrials, defense, and other equipment manufacturing businesses, that is somewhere where there can be a potential impact of tariffs. Could be autos, could be auto ancillaries. So I think these are the spaces which are generally more vulnerable to the tariff scene rather than IT or healthcare.
Okay, all right. Well, we'll leave it at that, Aditya. Thank you so much for joining us and taking us through your views on the markets and how we could potentially approach them here on. But with that, we are completely out of time on this edition of India Markets Open.